This is a Forex Preview here at XM.com. Thanks for joining us. I'm Cristina Marujos, and with me today is Cristina Bartenido, investment analyst. We'll be having a look at U.S. data. Cristina, we had a risk-off episode last week in markets with traders rushing to find safety in government bonds, the yen, and the Swiss franc as uncertainty started to surround the pace of economic recovery in the U.S. and generally in the global economy. This week, however, we have US CPI figures for the month of June on the calendar on Tuesday at 12:30 GMT, followed by industrial production on Thursday and retail sales on Friday. Could the data reboost growth optimism?
Hi, Christina. Indeed, it seems that there was a moment of realization in markets last week about how risky is the COVID virus and its transmissions, and that the vaccinations alone cannot guarantee that we will return to pre-pandemic conditions soon. And that created new questions about whether the central banks will start or continue with the bond tapering process, if, of course, they haven't already do so. What we currently see is that several countries seem to be at the start of another wave, and although the US cases have barely increased and look mostly stable for now, they will be closely watched in the coming months, as well as the employment and inflation readings. The latest non-farm payrolls report was mixed, showing a robust increase in jobs and a small rise in the unemployment rate, which the markets didn't like, of course. This week, the CPI readings will likely send mixed signals for June as well. The core CPI is expected to increase to 4% on an annual basis, and the total CPI to ease to 4.9% from 5%, with the monthly figure also slipping a bit lower. Now, these forecasts are still elevated and well above 2%. So if that's the case, then concerns around high inflation will not change much, especially if the US producer price index climbs to 6.7% year on year on Wednesday. That will be another bad sign for inflation and for consumer spending, of course. Retail sales and industrial production are also expected to slow down, but not dramatically to change the outlook for the US economy or reboost growth optimism. But that doesn't mean that the data are not important to look at. The Fed is relying on data developments to decide whether it should start tightening its policy or keep settings unchanged. However, what the Fed cares most about at the moment is the labor market. Of course, we saw some policymakers getting more nervous about the rise in inflation, but the overall message from the Fed is that the spike in price growth will fade soon, and instead the priority now is to absorb the slack in the US labor market and push the millions of unemployment people back to work. So perhaps the jobs numbers could get more attention, at least in the period before the Jackson Hole meeting in late August.
And now turning to the dollar, it didn't gain much from the flight to safety last week as the traditional safe havens, such as the yen and Swiss franc, got a bigger boost. But could the US data reactivate the rally this week?
Well, the risk on sentiment seems to be recovering at the moment, and unless we don't get any bad COVID headlines, then perhaps the dollar may shift higher, but I don't think that this week's data may bring big moves to the currency. As I said before, the US labor market is the priority, so perhaps CPI and retail sales data may not cause much volatility. However, we shouldn't forget that the earnings season will officially start this week with the big banks reporting on Tuesday and Wednesday, so probably we may see some movements in individual stocks instead.
Cristina, thank you for joining me today. This was a Forex Preview on US data coming up this week. Thanks for watching at XM.com.